Welcome to the Rennie podcast. I'm Ryan Berlin, Head Economist and Vice President of Intelligence here at Rennie.
And I'm Ryan Wyse, Market Intelligence Manager and Lead Analyst at Rennie.
And we are delighted to be joined today for the first time by Sydney Robinson. Sid, how are you?
I'm doing great.
Super. Thanks for being here. You've been in property management and leasing for over a decade.
Yes.
You were at Bosa Properties in leasing before you came to Rennie in 2020.
Yep.
And now you're our Director of Leasing.
Yes.
So what is that and what do you do?
I work on the developer services side of Rennie. I specialize in all things rental, but I do primarily work on the strategy and execution of the lease up of new rental projects.
Awesome. And you're keeping busy?
Yes, very busy, very, very busy.
Which is why you're here. So thank you for taking the time. We want to spend some time today, I think for the first time ever, actually dedicating some airtime to rental, which we probably should have done earlier. It is a fundamental cog in the housing machine here in this region. So today we will get to that. We'll talk about the state of the rental market in this region, Metro Vancouver. We'll discuss what renters are looking for and how developers are responding to current conditions, which have been evolving fairly rapidly. We'll talk a bit about how purpose-built rental differs from investor-owned rental, and then we'll share a forecast of rents and talk about what that means for renters. So we'll get to rental. That's not all we're going to talk about today. Let's start with you, Mr. Wyse, to give us a bit of an overview on what's happening in the for sale market here.
For sure. So resale, quite similar in June to what we talked about. If you listened last month to the May numbers, we talked about how things had kind of bottomed out in March and April. We had such a loss of consumer confidence. I think April was probably the bottom in terms of sales activity. And so they picked up a little bit in May and they were kind of flat in June at just over 3,300 sales for the Vancouver region. So that's similar to May, much less than last June, 32% below average, but still much higher than those lows of March and April. And typically the busiest time of the year is March to May, and then sales start to drop off in June. And so it's a bit of a different path this year as things have been quite different for us. So the first 6 months of the year, sales are fewer than 18,000. So that's the third lowest sales count for first half of the year going back 2 decades. So 2019 and 2020 were the only years where we saw fewer sales, January through June. And of course, you can throw out 2020 as being such an outlier year. So really just only 2019 had fewer sales to start a year than we had this year. You know, obviously everything that was going on, international trade, stuff with the US, still rates are a little bit higher than they used to be. All that stuff kind of sort of came together for a pretty slow first half of the year on the sales front. And then new listings, we've been talking for months about how they've been elevated. They were elevated again in June, still 14% above average on new listings. First half of the year was the second highest going back 2 decades, only higher than 2021 when the market was so busy that so many people were listing because there was so much buying activity that was going on. And so all that new listings activity, such few sales, we're in a point where there's more active listings at the end of June than at any point in the last 13 years at more than 26,000 homes for sale.
That's a big number.
Which is a lot.
So yeah, I'm curious on the new listing front. It's something for us off camera to look into. How many of those new listings are relists? Because we're not seeing the downward pressure on prices. I am quite frankly surprised that the new listings continue to trend above where we were last year and that hasn't leveled out.
So there's another metric that makes me think there's a lot of relistings. So we can try and measure that directly, but indirectly, the days on market of active listings is falling. And so it's less than it was last June. Yeah. So there's probably a lot of expiries or cancellations and relisting coming into that metric. And there's such a flow of, quote, new listings coming in that I think there is a good chunk of that is relistings. Yeah.
So what's the latest on pre-sale? Because we all know that the Q1 numbers were somewhat less than inspiring, but it feels like Q2 has activity's picked up.
It has. We get full Q2 numbers any day now. We don't have the full results, but we're trending probably over 2,000 for this region. Again, final numbers to be determined. Last quarter was just over 1,400. That was an all-time low.
2,000 sounds great right now. 2,000 is not a good number in the grand scheme of things.
Historically speaking, that's very low for this market. But we saw some Toronto numbers come out for some horrifying context. Q1 in Toronto was like 550 for just condos, not just condos, excluding townhomes. That was their lowest quarter ever, and Q2, according to Urban Nation, was 500, so a decline from Q1 to Q2. And seasonality, typically Q2 is a lot busier. They include Hamilton, so that's like a region of close to 8 million people, whereas we're 3 million people and doing probably 3 times that on the condo side. So of those roughly 2,000, I expect like 1,500 condo. So we're seeing like 3 times as much activity, and we're a third roughly of their size. So things are very different here than they are in Toronto.
Fortunately, yes, as difficult as it feels. So I think in the next episode, the next recording of this podcast, we'll have a more fulsome picture of the pre-sale market. Definitely. We'll dig into that then. Sid, I want to bring you into this conversation in a moment so we can actually talk about rental. But a couple of things for you, Wyse, we can't ignore. Jobs data release last week and consumer price index data release this week. And what it means for the Bank of Canada.
So the jobs release was very strong, but we need to start off with the caveat. So the labor force survey that we get the jobs data from, which StatsCan administers, is a really small sample size. So month to month, it can be really noisy. And so, we'll see in the coming months whether June was the beginning of a new trend or whether it was partly some of the noise that, traditionally comes with LFS. Before COVID, we didn't actually look at this stuff on a month-to-month basis. We used a lot of rolling averages.
You're not really supposed to, right?
Yeah, but we're always looking for as real-time data as we can possibly get because things are changing so quickly. And so all of those caveats aside, Canada added 83,000 jobs in June on a seasonally adjusted basis, which is a lot.
Yeah, that sounds good as a headline
great.
number.
The number of unemployed persons fell by 20-something thousand. That's great. Unemployment rate fell from 7 to 6.9 nationally, in BC to 5.6. Good news, good news. Participation rate increased. Good news. Employment rate increased. Good news. The only sort of mixed picture there was most of those job additions came in the form of part-time positions. And if you dig a little deeper, the biggest group within that part-time increase was people who wanted to work full-time. And so there's still a good chunk of people that maybe weren't getting their desired labor market outcome, but instead of being unemployed, they're just working part-time when they'd rather be working full-time. So not quite as good as if all those jobs were full-time, but still a really positive 1 month. Let's not overstate 1 month of LFS data, but it was certainly a good data release. Still, headline inflation looks pretty good. It ticked up from 1.7 to 1.9. Target is 2%, so we're just under target. Great. But core measures are still elevated. Part of the reason that headline is quite good is the removal of the consumer carbon tax. We've talked about how we sort of get the benefit of that for a full year because it's a year-over-year percentage calculation. Core measures, which strip out like the most volatile elements like gas, which gas prices are always volatile. And we're seeing, again, lower gasoline inflation because of carbon tax reasons. So the core measures are all around 3%. That's on the high end of where the Bank of Canada would like to see it. And ultimately, I think just real quick, the combination of these two data releases, where we're at on inflation, where we're at on jobs, and the fact that the Bank of Canada's current policy rate is right smack in the middle of neutral. We've got ongoing trade discussions with an August 1st deadline, and the next Bank of Canada announcement is July 30th. All of that says they're going to hold. I think there's a pretty broad consensus that they're just going to wait and see. Let's get some more jobs data. Is this a real pickup in hiring, or is this some month-to-month noise? Let's, keep our eye on this core inflation stuff, and then let's see the outcome of a potential trade deal or tariffs and model those new scenarios.
Yeah. So we need time. Everybody needs time. The chaos that has been sown by the U.S. administration and what that means for us, it's very difficult to read right now. Like there is no agreement that has been put into place. So we have no certainty on that front. And then you layer in some of these sort of short-term changes in the labor market and in prices. And we need another 2 to 3 months before there's a clearer read on things.
Yeah. So July 30th, we'll get a hold. And then it's early September, the next announcement is. And there'll be a lot more clarity on some of this stuff by then.
I would be surprised based on what we know now, unless the jobs reading is very poor for August. And I believe that September meeting is early in the month.
It's early in the month.
I'm not sure how that lines up with the jobs data release, but it would have to be a couple of poor readings for the labor market, a plateauing at most in consumer prices to see a cut there, I would think. We want to talk about rental. That's why we're here. That's why you're here. Yeah. You're like, okay, whatever. For sale, pre-sale, yada, yada. I have a lot to ask you. We have a lot to ask you, and we want to cede the floor to you. I just want to start with a little, I don't know if it's a primer on the rental market, but just for some context for listeners or viewers, because we do mostly talk about the for sale market. We talk about resale and we talk about pre-sale. If you look at all the households in Metro Vancouver, that's 2/3 of this region. 2/3 are owners, but 1/3 are renters. Renting is a more accessible form of housing than ownership is on account of there not being a sizable down payment. Like there is a deposit, typically 1 month's equivalent of rent, but nothing like what you see in ownership. And to rent a unit versus own it, you're likely paying quite a bit less, which is why the math doesn't work for investors right now. 1/3 of the households are renters in Metro Vancouver. More than half are in the city of Vancouver. So it takes up a lot of space. And you look at city of Victoria, the numbers are huge too. I think they're closer to 3/4 or something like that. The thing is, our purpose-built rental stock is pretty old. 2/3 of it was built before 1980. So like we're coming up on that part of the rental stock being 50 years old and in need of improvement. So 2/3 of the purpose-built stock in this region is almost 50 years old. Almost nothing was built between 1990 and 2015. And over that period, the population in Metro Vancouver almost doubled.
That's true of almost every market in Canada. Like Montreal is the one outlier to that. Almost no one was building purpose-built rental in this country over that period of time.
Yeah, the economics didn't support it, and there was a focus on the condo market, and condos were selling. I guess that lack of new supply, at least from purpose-built, we'll talk about the investor-owned segment in a moment, has yielded vacancy rates in Metro Vancouver that are essentially the lowest in the country, right? So like over the past 20 years, we've had a vacancy rate north of 2%, which is very low. It still represents an imbalance with too much demand chasing too little supply. But it's only been over 2% twice in the last 20 years. One time was in 2009 during the Great Recession, and then the other time was in 2020.
Throw it out.
It's currently at 1.6%. Let's turn things over to you. I want to focus on the purpose-built rental segment. There's been a lot more construction in the past decade, but it's only accounted for, over the past 2 decades, about 20% of growth in the rental stock, because 80% of it was due to investor-owned condos coming to market. I know that is changing. Like it's been changing over the last 10 years, but I think even over the past couple of years, we're seeing a major shift for a couple of reasons. Do you want to talk a bit about what's driving that growth and that change?
Well, I think we went a long time without any rental projects being built, like you said earlier. And we just kind of got to a point where people were being priced out of the market, especially in areas like Vancouver. It's just becoming too expensive to live and having to move outside the city, which has, been difficult for for employers that are looking for people to work here.
There's almost a missing piece when we talk about housing and living close to work. We don't give enough consideration, I think, to the transportation network.
Yeah.
And I think if we were able to make more investments in that, and we were able to make commuting further, faster, and cheaper, we wouldn't have that need to all pile in to where the jobs are, right?
Yeah.
A third of the jobs in the region are in the city of Vancouver. The city only has 25% of the population. So we already have that imbalance. But anyway, let's talk about purpose-built rental in relation to investor-owned. And so for someone who's maybe not aware of those two segments and what makes them different, what are some of the pros and cons to each?
One of the big benefits of living in a purpose-built rental project is what we're seeing today is the community aspect of it. Today, new purpose-built rental projects are designed with shared spaces. So you have amenities like co-working space, lounges, rooftop patios, and they really encourage people to get to know each other and get to know your neighbors and really create that sense of community. And I think post-COVID, with so many more people working from home, that's just becoming much more important. I think one of the other benefits of living in the purpose-built rental project is the sense of security and stability that you get from it. You don't have to worry about your home being sold, and that
Which
you may,
is huge.
Huge.
Yeah.
And you may have to move at a time that you're just as not convenient for you. And then,
so do you see during like lease ups that you're working on a lot of people who are currently renting in a condo, like, hey, my landlord just listed this condo for sale and now I need a place to live or a different place to live. And so I want to look somewhere that's a little more secure?
yeah, 100%, especially if they're like in a position that they have to move at a time that is just really difficult for them. I think what I'm also seeing as well is that sometimes renters aren't very educated with their rights when it comes to, being asked to leave because the owner is selling. So they're not aware of their rights when it comes to that. So they kind of lean back into living in a more professionally managed building or purpose-built rental building that they could stay in.
So while we're talking about renters, you've been in the business of leasing and property management for a decade. What is it that today's renter, if we can sum it up nicely, what are they looking for today?
I mentioned previously, like the sense of community is huge. I think what we're seeing today in buildings is, especially in the past couple of years, so many people new that are moving into the city and they don't necessarily know a lot of people, and they really gravitate towards purpose-built rental communities because of that. I think, with so many more people working from home, having a place that is almost an extension of your home, having that co-working space, that gym located in your lobby that's easy to get to, those things are just becoming more valued now.
There's been a lot of purpose-built rental coming to market. Like currently the construction pipeline is very full. So we're at a multi-decade high in starts. All of that new supply coming is happening against a backdrop of slowing population growth. We might be moving into a period of population decline. The economics of purpose-built rental have to be more challenging today for developers.
Yeah, definitely. Yeah.
Than they were. So how are developers responding and adapting to these conditions?
Today, developers are listening more to what renters want in these communities, and they have to if they want to stay competitive in the industry now with more projects coming to market, taking in feedback from renters, what amenities they value in buildings, what all the way down to like the home design as well.
I mean, it's pretty new for landlords to compete for renters in this market. It used to be the other way around, where prospective tenants were competing to get the home.
Yeah.
Whoever had the best application generally got the home because there were way more applicants.
Which is great, because before it was so scary to have to move, because you would show up at a showing and there would be a lineup of 20 people all with deposits in their hand. And, you may put yourself in a situation just because you have to find a home to live in.
Is there a profile of developer that is able to withstand these conditions better than others, or that thrives in these types of conditions?
Yeah, I feel like today with like the current economic environment, definitely developers that have been around for a while and they've been in, more lows with the economy, they're able to withstand the market a little bit. Yeah, they just have a little bit more experience with it. Yeah.
Rents have been softening, I think, for about a year. We forecast over the next 2 years, based on lots of new supply and demand softening a bit, that rents will decline for the next years. Beyond that, we expect that growth will resume, and that by 4 years from now, rents are going to be back at where they were in 2023, which is the previous peak.
Yeah, just to clarify, that forecast is for asking rents at turned over units or new purpose-built units.
Correct.
And so existing tenants might still see like rent growth of the allowable, 2% increase, that type of thing.
Absolutely.
So
You're right.
We could see a convergence between existing rents and asking rents, which is probably a healthy thing for this market.
If there are more options, right, for existing tenants, then landlords may be less inclined to raise rents.
Also, if you're one of those people that's paying below market rent and your home no longer works for you, maybe it's a little bit easier to shop around for a new home.
Yeah, I think it relieves some of the older stock in the market as well. So we see people that are moving up. They've been, in their home for the past like 10 years. They're paying low rental rates, but, they want to move to something new. And, they're adding that supply to the market that may not be able to, afford the high rents.
Yeah.
Especially if you're in that pre-1980 stock.
Do you want to share any thoughts on projects that you're working on or developers that you're working with? Anything that's exciting?
Yeah, definitely. So we have a project that is just coming to market now. It's located in Marine Gateway in South Vancouver. It's called Signal, and it's a project by Inchicorp and Oxford, both two very renowned developers. And it's 2 towers, 524 homes, which is exciting. Our first move-ins are going to be September 1st. So we're just kind of starting hard hat tours now. Yeah, it's located right next to the Canada line. So super easy to walk over. You could get to downtown. You could go back to the airport. Yeah, very convenient.
Awesome. Cool. Any others?
Another one we're working on is in Kelowna, actually. It's called Kovo. It's a project by PC Urban, and it's located right on the outside of downtown of Kelowna. And it's been very exciting to be working on a project up there because I used to live up there. So it's nice to be able to go back to the Okanagan and spend some time there, especially in the summer. I try to make as many trips as I can. Yeah. And we're just starting tours there with our first move-ins for August 15th.
So if anybody's listening and is interested in learning more about these projects and wants to get in touch with you, how can they do that?
So you're welcome to send me an email. My email is robinson@rennie.com. Of course, you could call the Rennie office and they could direct you to my phone as well. Or you could visit the Rennie website to see further details about the projects that we're working on.
Super. Awesome. Thanks for sharing that. Let's move on to our Beneath the Headline segment.
I had to bring two. So
you brought two.
I picked out a rental headline that I have an issue with that I really wanted Sydney to get your take on it.
I'm excited.
But before we get to that, there's a second one that just came up today that really bothered me, and I just have to vent for a sec. So the headline is 60% of Canadians could face higher mortgage payments by 2026, Bank of Canada. And they say that they're attributing this to the Bank of Canada. If you click on the Bank of Canada report, that's not all what they say. The Bank of Canada says that 60% of mortgages renew by 2026. And 60% of those people could face higher payments. There's still a disconnect here because 2/3 of Canadians own a home, as we talked about earlier, and only 60% of those owners have a mortgage. So you take 100% of Canadians, 66% are owners, 60% of those have a mortgage, 60% of those are renewing by 2026, and 60% of those could face higher payments. There's a lot of sixes.
Going up.
So if you do the math, it is 14% of Canadians could face higher mortgage payments by 2026, which is not insignificant. And I'm sure if you're one of them, you don't want to hear me be dismissive, but it's just a false headline.
That's 1 out of 7 versus 3 out of 5. Exactly. So there's a very different narrative there.
I just had to vent on that one.
That's fair.
So that one aside, the other one I have, and Sydney, just go ahead and answer. This headline is a question.
Okay.
Is Canada building too many rental apartments?
Definitely not the case. People look around. They went so long without seeing any rental development that the development that's happening today just seems like so much. But as you mentioned kind of earlier, we're still seeing, rapid population growth in the past few years, and we expect it to go back up in the next few years. And it's important that we have to, keep building more homes. Otherwise, it's just going to continue to become unaffordable for people.
So I want to pull a quote here, and I'd love for you both to chime in on this from this article. Since 2024, rental supply has grown faster than new demand. What happened before 2024? You already said.
We have data. We've looked at this, and if you go back to 1990, it's kind of a crude measure, but go back to 1990 in Metro Vancouver, and there were 71 purpose-built rental homes per 1,000 residents. 71. You fast forward to last year, because that's our last data point, there were 42. So it's an almost 50% drop in the number of rental homes per capita, essentially. So it's not to say necessarily that 71 is the magic number, but we've seen this downward trend as our population has grown. And by the way, when we grow through migration, and migrants are young and migrants rent, right? So to your point, Sid, it's not about building a lot now, pulling back, building in waves, right? The fits and starts that we see often in construction and development. We want to ensure that we're building a lot of rental for a long time. I think right now there might be a bit of a surplus of new rental coming given current conditions. But all of those rental homes are needed in the fullness of time. Like you just go out, like to your point, Sid, about population growth resuming fairly robustly beginning in 2027. Like we are going to need lots of new homes. So I think it's way oversimplifying things to say, oh yeah, we're building too much.
Yeah, I think one thing that we're also seeing, particularly on the North Shore, is it's not just young people renting, it's also older people that are renting as well. They want to, sell their home. They want to move somewhere that is going to be easier to take care of, that they could spend half the year down somewhere warm. Renting has become more of a lifestyle. And also with these new projects, they're just more accessible than before. While prior, you had a lot of rental projects that may not have like an elevator or other accessible needs. So it just becomes easier for, that group to live in rental projects as well.
So we have a listener question from Sophie in Burnaby.
Hey Ryans, this is Sophie from Burnaby. I love tuning into the Rennie podcast every month. My question is regarding the rental market. There's been a lot of talk about it being a renter's market right now. There seem to be much more listings available and landlords offering incentives like 2 months free rent. Do renters have more negotiating power, or is it just temporary noise without much traction? I look forward to hearing your insights on this.
Yeah, no, I agree. Renters do have more negotiation power than they did previously. But I think that's a good thing because, it made developers really take some renter feedback and really design projects that are more livable and more thoughtful communities, which in turn benefits renters.
Thanks for that, Sid. We'd love to answer your real estate questions. You can either email us at intel@rennie.com, or you can leave us a voicemail at speakpipe.com/the Rennie podcast, and we'll try to respond to your question in the next episode. Sid, thanks again for being on. That was great.
Thanks for having me.
It was a lot of fun.
Yeah.
All right.